Welcome to The Pitch, brought to you by Livewire Markets. I'm Huntsley, and our guest today is Kris Webster, co-founder and portfolio manager at Canopy Investors. Canopy was set up by three portfolio managers who all met while managing Magellan's global investments. So today we're going to find out how their journey to go it alone has gone so far and where they're finding opportunities today. Kris, welcome. It's great to have you with us.
Thanks, great to be here.
So, as I mentioned there at the beginning, you left Magellan and have started your own shop alongside Michael Poulsen and Jack McManus, who we'll meet in future videos of The Pitch. So, I'm curious, how's it going? What are some of the major learnings you've taken away from the first few months of being in business?
I started at Magellan very early days, about 2008. And so what I really took from that period was that obviously you need great investments to build a fund, but to build a great investment business, you also need operations and distribution. And so early on we decided that we were going to partner with Benelong. They've already got great distribution, already high quality operations. And so, we can leverage that and then focus on what we do best, which is finding great investments and managing the portfolio. And that's been a great decision.
So with that said then, you were all at Magellan beforehand. Do you find that you've just replicated that strategy, or how have you tried to differentiate yourselves?
Look, so Mike and Jack and I have been working together for over 10 years at Magellan. We built our philosophy and process over that period, so a lot has stayed the same. So what stayed the same? We focus on quality above all else. We think that's where the greatest ability to generate returns is. We focus on margin of safety, so very valuation focused. We are risk aware. We're trying to minimize the risk of permanent capital loss. We don't consider risk to be volatility. And we're very, we like concentration. So our portfolio is 20 to 40 of our best ideas. So that's where we're the same, but we're also a bit different. I would say a major difference is that we're not as macro focused as we once were. We think you've got to focus on it, you've got to think about it, but we want the portfolio to do well under a range of circumstances, not just picking one. And what it means is that we're fairly fully invested at all time. Another thing is that from day one, we've been a co-PM structure. We think that generates better ideas, it means we have less bias, and we've set it up in this way that we think that we're still all individually accountable and nimble. So we think we set it up right. And one of the other things is we're no longer part of a big team and a mature organization. We had a clean sheet of paper, and so that we could adopt the latest software and technology straight off the bat. And so generative AI has been in our process from day one, and we think it's really improved the efficiency of our analysis and our idea generation.
And you talked about macro as well, and how that's kind of your reliance on macro has maybe lessened a little bit since when you were at Magellan. How do you think about macro then in this role at Canopy? And I guess asking somebody with your kind of lay of the land, especially with global markets, are we in for more volatile times ahead on the global front?
Yeah, so we do definitely focus on the macro. It's not something that's changed, but what has changed is that we're not taking a specific view. And part of that is an experience of, you can sometimes get the macro right, that's very hard, but you can sometimes get that right and then get the market completely wrong. So I'll give you an example, right? In end of 2022, you had inflation coming up after COVID, you had interest rates going up from, I think, just over 1% to over 4% over the course of a year. And the common view was, well, if rates stay high, then markets and economies are going to struggle. Fast forward 2 years, rates have stayed high, and yet the S&P has rallied 50%. So you get the macro view right, you get the market wrong. And so we just want to position the portfolio to do well in a range of circumstances, not having to get every little thing right on the macro.
Yeah, no.
With respect to the volatility, I think with the Trump presidency, that's about all we can be certain of, is that the next 4 years are going to be full of volatility. The thing that we're most focused on from a macro perspective in the near term is really around interest rates. A lot of Trump's policies, if they're enacted, are inflationary. And if inflation does come up, interest rates could again rise, and that could be negative for markets. I say could, it may or may not happen. On the other side, you've got disinflationary policies. Energy investments could bring oil prices down, government efficiency could be disinflationary, and Trump could just change the policies because the market doesn't agree with them and he focuses on the stock market. So all of this just leads to more volatility ahead.
Yeah, no, absolutely. So with all that said, where are you seeing the most opportunity today?
our universe is 7,000 stocks, so there's always opportunity
Just a few
somewhere.
of them, yeah.
Just a couple.
Lazy 7,000.
And so I've thought of a couple which I thought might be interesting. So the first one is called TradeWeb. It's a fixed income trading platform. So if you think equity trading is typically done electronically, so think ComSec or something like that, whereas fixed income trading is not yet at that level. So one of the biggest markets they deal with is interest rate swaps for US Treasuries. This trades multiple trillions of dollars, and yet only 30% of it is electronically traded. The rest is done over the phone. And so TradeWeb is the biggest company that is effectively facilitating that shift to electronic. And it's obviously benefiting a lot from that. That's got a huge runway to go. It's not only doing it in that interest rate swaps, but it's expanding to different asset markets. In the shorter term, if you do see the Trump policies lead to more interest rate volatility, that also generally leads to more interest rate trading or fixed income trading, which is beneficial to TradeWeb. Another one is Steris. It's a US healthcare company. So it focuses on sterilization. So most medical devices and pharmaceuticals, before they make their way into patients, have to be sterilized at least once along the chain. And Steris basically focuses on that. It's got very high market share, particularly in the US. Most of its revenue is recurring. And it's also got good long-term growth themes around more hospital procedures and the aging population. It, however, in the short term has suffered from the Trump presidency. Most healthcare has gone down with the health secretary being nominated as Robert Kennedy. There's a lot of uncertainty about regulation, and Steris has been caught up with that. But out of all the healthcare companies, Steris has actually got low exposure to regulation, and so we consider it an opportunity.
Where do you see the most risk? Is there, a crowded market, darling, that you're trying to avoid?
Well, look, there's always pockets of excess. What we would say is post-election, there's been a lot of excitement in the market generally, but in certain pockets, particularly that are exposed to Trump's policies, such as lower US taxes and lower regulation. So one of those areas is US regional banks. That part of the market is up about 15% since the election. So US regional banks isn't a particularly high quality part of the market. It's very competitive, it's highly regulated, and every few years there's some sort of crisis. So last year it was Silicon Valley Bank.
I was about to say.
So what we would just say is, yes, these companies, if the policies are enacted, benefit, but given the level of uncertainty, we would just be cautious in over-extrapolating the benefit they're going to receive, particularly in low quality areas of the market.
This has been brilliant, Kris. Thank you so much for joining us.
Great, thanks, great to be here.
And thank you for joining us. If you enjoyed that interview, you can subscribe to the Livewire Markets website, as well as our YouTube channel, where you'll find more episodes of The Pitch. We'll see you when we see you. Take care.